Hello and welcome to week 5's lecture for Finance, Financial Markets and Institutions, and in this lecture we're going to cover the integrity and ethics required to work in the professional practice of the financial services sector. So far in this module we've covered what is regulation, the different types of regulatory bodies, and then we've looked at how these regulatory bodies authorise individuals and firms to operate, and then we have covered how these firms should conduct their business in line with the customer's interests and how they treat customers fairly through the whole process of selling financial services products. But already throughout this thread of lectures we've used quite a lot of language that refers to ethical behaviour, and certainly the word integrity, which has been repeated on numerous occasions, certainly during the authorization stage of individuals, and how individuals must treat customers fairly and uphold their integrity. And this all comes from the concept of good ethical behaviour within the whole selling financial services products. And we'll cover this in more detail today. And then this will lead on to next week when we talk about where ethical standards slip and potential for financial crime to begin. So, the learning outcomes for this lecture is to understand the core ethical principles and values that should be required to work within the financial industry. And we'll look at the number of codes of conduct from the professional bodies for this. We'll explore the differences between ethics and integrity, and then we'll look at examples throughout the financial services sector of where ethical dilemmas may arise. And this will be followed up in your face-to-face session or seminar work, where we'll do lots of ethical dilemma examples. So first of all, what do you think about ethics? Where does it actually begin? And what defines our own personal ethics? Well, I believe it all starts with values. And if you think from a rational and irrational point of view, ethical values is actually an irrational behaviour. It's very emotive, thus being irrational. And if we make decisions based on irrational behaviour, then sometimes them decisions don't really work out. Certainly when it comes to investing. But where do our values arise from? Well, everyone has different values. And at this point it's worth saying that no one's values are better than another person's, but it's always up for a healthy debate. So if we look at people from the financial services industry, people will have their own personal ethics and values. So they'll have their own values. But they might work within an organisation that sets different values. So corporations, financial services companies have to set the corporate values that the institution will follow, and hopefully its employees will also follow. But then individuals working within corporations are selling to society. And there is a vast range of societal values, depending on the different parts of the country you may work, depending on which country you work in, and societal values may differ substantially from your own or your corporate values. Therefore, we all need to be respectful and mindful of other people's values, and if needed, enter into a healthy debate to find a common ground within our own values. But also, as an individual, you never know, your values might actually clash with your own organisational values. So then what do? Do you start to change your own values in line with the corporation's values? Or do you try and help the corporation understand your values? And this is something you might want to have a conversation with the likes of your line manager to potentially be open and honest to have this discussion. What happens if you're an individual and you're dealing with a client who has very different values to yourself? Do you look for a common ground? Or do you then potentially work with the customer to pass them on to someone else who shares the same values. So how do you deal with situations where there's plenty of value clashes? And this is where you potentially need to uphold your integrity and be respectful to others, and then admit and have an open, honest discussion about said values in the interest of your customer, and then potentially, if needed, step aside and let somebody else deal with this customer potentially. But this also goes back to the previous comments we've said before regarding the regulatory stance, and that is to treat customers fairly, which starts from a mindset of good values, being open, honest, and have a good integrity. So, what is the textbook definition when it comes to ethics? What do you think? So what actually comes into your mind when we say the words ethics? Well, very often, for us it's easier to work out what's not ethical than what actually is ethical. So normally we come from a negative screening point of view where we just say, oh, well, that's unethical, that's unethical, that's unethical. But we don't actually say what is ethical. But ethics comes from historic philosophical debates that tend to be from academia and religion. But when it comes to ethics within business, normally this falls under the conduct of good business. Certainly from the regulatory point of view, the conduct of good business PRINs, which we covered before, do have an underpinning from an ethical standpoint. Therefore, if you're following the principles of good business, then you're working in an ethical way. The problem with ethics and acting ethically is that in very different scenarios, you might react differently and suggest that you're working within an ethical mindset. But we can't explicitly define what this actually is, because it does link back to the likes of your values and so on. Therefore, acting ethically is what's known as a discretionary process. You might think you're working ethically, however, someone else might think you're not, and that's where we need to have a healthy debate as to what is working ethically and what isn't. And if we see someone that we believe is working unethically, we can bring that up in a non-confrontational manner. So how does ethics differ from integrity? Well, integrity is about how you act, and it's about acting consistently in your decision making in line with your ethics. So integrity, another way of looking at it is acting consistently. If you're doing the same decision making in line with your ethics in various different scenarios, then that would be seen as upholding integrity. What wouldn't be is if you jumped between different decisions and acted very differently and changed your characteristics or your values depending on every single situation, then that wouldn't be very integral. So it's about trying to act consistent when making decisions. And as you can see from the third bullet point there, having integrity means a person takes decisions not just because it's what is expected, but it's because it's doing the right thing. And if I was to summarise integrity in a sentence, it would be practice what you preach. So, what about ethics within finance? Well, in this bit, I'm just going to show you a few examples. So, what do you know about the LIBOR rigging scam in the UK during the financial crisis? This is where individuals that worked within the banks were colluding amongst one another to artfully inflate the London interbank offer rate, which is the percentage different institutions will lend overnight or to 1 year. So individuals within different treasury departments of the different banks were all potentially colluding or phoning each other before they told the British Bankers Association at the time the rate the banks were willing to lend at. Therefore, this artificially increased the London interbank offer rate, and this is a rate that underpins millions of transactions. Therefore, if this rate is slightly higher than what it should be, then the financial institutions can benefit. So these individuals within the firms who are colluding with their counterparties in other firms, then were they working in an ethical manner? Did they just see this as the norm? Oh, well, just can't tell our mate. But we're going to tell the British Bankers Association. Or is this, financial crime, collusion, misleading? So as we'll cover next week, this did eventually end up in the courts. So not only were they acting unethically, they were acting against the law as well. You may have heard about the payment protection insurance mis-selling prior to the financial crisis, and I touched on this in last week's lecture, where firms and individuals were adding PPI onto customers' mortgages without them even knowing what it was, or in fact even telling them, and this was potentially to increase the remuneration for these financial advisors at the time. Therefore, again, this is misleading, it's mis-selling, it's not really acting in an ethical manner, and it's also not treating customers fairly and falls foul of the standards set by the regulators when it comes to working with consumers. Thus, it's not in their interest. And to this day, following the financial crisis, ethics within the financial services is been a key subject for academic research. So I would highly recommend you to visit our library, resources, look at the key journals within finance, and look at the various papers on financial crime and financial ethics. But also not even within academia, in the public interest and through the media, this has become a massive change since the financial crisis. And most organisations, certainly finance organisations, is trying to advertise how ethical they are and their approaches to ethics. And this has also been picked up by the various professional bodies, which we'll cover later, who have laid out their codes of conduct for becoming even a member of a professional body. Well, what constitutes as unethical behaviour? Well, one of the first bits of research into this from the regulators was in 2002 by the then Financial Services Authority, which highlighted 3 things they considered to be unethical behaviour, and this helped form their discussion paper 18 on good ethical standards. Now, it's interesting that this took place in 2002. Given the 3 things they pointed out here, then are these not the 3 things that eventually helped exacerbate the financial crisis? So if we look at the first one, targets, short-term pressures on the likes of financial advisors to hit targets, then this is potentially a opportunity for advisors to kind of cut corners when it comes to selling of financial products. So if we have targets, and this can ultimately lead to the likes of staff potentially not informing customers properly, not giving them all the risks, and potentially pressurizing to make decisions on them more quickly, and again sometimes act without the customer's interests in mind, when potentially the advisors are getting remunerated, or potentially their jobs depend on a certain number of targets. But this can also lead to a culture a bit higher up of getting things through the door and not really caring about the after sales process, which in the long run could lead to customers not actually getting the product they wanted, or potentially increased complaints. Another point 2, is some individuals behaved unethically because they think it was worth the risk. So in other words, they might have done their own cost-benefit analysis of working unethically compared to potentially what they get remunerated or the sanctions they face. For instance, one of the previous examples I gave was the likes of Wells Fargo was rewarded their frontline staff for opening numbers of bank accounts. Well, opening bank accounts without the customers knowing is not treating them fairly. It's not doing it in the interest of the customers, but the advisors at the time or the front staff were getting remunerated. And potentially, but does it matter that the customer's got an extra bank account? Yeah, they might not notice, I don't know, but it's going to help my pocket. Then potentially they rationalise it and say, well, what doesn't make a difference if they've got an extra bank account to them? Surely they won't mind. But to me, it means better numbers. And in some cases, they might have known what the sanctions were. So if you break X rule, you might get sanctioned X amount of money. But the rewards are much higher than the sanction. Therefore, I'll do it anyway. So even with non-compliance, you may still benefit because the sanction or the fine isn't great enough. And the last one is that some people may be unaware of the values embedded within the financial services standards. So they kind of just comply with the letter of the law, but obviously the letter of the law doesn't mean you have to work ethically. You're just complying with the law, therefore what's wrong? I'm not breaking the law, it's fine. A good example of this, which I'm going to use outside of finance, is the likes of doping in sport. Now, there's obviously very strict rules and regulations regarding what you can and can't do in elite sport regarding doping. But there's very well documented cases of people getting as close to the letter of the law as possible. So they're not breaking the law, but they're still getting an advantage against other competitors because they're doing something that other people are not. Now, as an athlete myself, a clean athlete, I'm thinking, well, if they're doing this and getting as close to the line as possible, should I be doing the same? Or shall I just train harder and become a better athlete that way? But, like I said, there is certain individuals out there that have really got very close to breaking the law, but they're not. But they're still taking some sort of performance enhancing product. And this potentially leads to a race to try and outbeat the anti-doping standards and kind of be an advanced race when it comes to medical science to try and be one step ahead of the doping authorities. Which, again, is that ethical behaviour? When you're trying to get as close to not breaking the law as possible, is that ethical? Should you not just train harder and become better that way, rather than trying to increase your knowledge of science and try to outperform the doping standards? Well, for me, that's not ethical at all. But, as I've mentioned, ethical situations, there's no straightforward yes or no, or right or wrong, depending on the type of situation. Therefore, when it comes to likes of integrity, if you act in the same way when it comes to different situations, you're upholding your integrity, but we have to try and judge what we believe is ethical in whatever the situation presents us. In some situations, the answer might be quite simple, but however, in other situations, then quite often it might be a rather difficult choice or a difficult scenario to handle. Therefore, we have to try our best to work within an integral manner, even if this means potentially losing customers. So what about the kind of pecking order of ethics within the financial services sector? Well, from a regulatory point of view, the ethical standards prioritises the customer. So this again falls under treating customers fairly. So your client is your first interest. then your second interest is the firm's ethics, and the final interest is your own. Therefore, as a frontline financial advisor or someone that's selling services, then the last person you should be thinking about is yourself and your own financial remuneration. You must be acting within the customer's interest and helping them achieve their financial goals, not your own personal goals, but also do this in the confines of your firm's ethical standards. So if there is an instance where your customer's ethics or your customers making you do something that's unethical, that goes against the kind of firm's rules, that's when you have to be open and honest and tell the customer, sorry, I can't do that because it goes against our company ethics and ethos. So you must treat the customer fairly, but if the customer turns around and wants you to do something unethical on their behalf, you have to fall in line with your firm's standards and not do that. So, what does ethics mean from a regulatory point of view? Well, we've seen these words before, and this is from the Financial Conduct Authority, and will be the same for various different conduct authorities around the world. So the likes of honesty, reliability, impartiality, and openness. And you can read the definitions there, but we have covered these before when we talk about how individuals are authorised. But if we look at the professional bodies now, they all have their own code of conduct, which really does fall in line with these languages. So I've got two up here from the financial services sector. So here's firstly the Chartered Institute of Securities Investment. But again, look at the words honesty, open, transparency, and fair. And they've set out 8 different principles regarding code of conduct when it comes to ethical behaviour. And they also set out a disciplinary process if you're a member of this body and you're found to be not in line with these 8 principles. To become a member of the Chartered Institute of Securities Investment above a student membership, which some of you may have through your programme, you actually have to pass an ethical situation online test before even becoming a member. And if you fail this test, then there's a certain level of training or period you have to wait before doing the test again to become a member of this professional body. If we look at the Code of Ethics and Standards from the Chartered Financial Analysis Institute, again, it's using the same language. And in this PDF, it covers their Code of Ethics in 6 bullet points, and then goes to the Standards of Conduct in Professional Business, which covers items such as professionalism, integrity of the capital markets, duties to clients, and so on. Again, if you're a member of this professional body or gain their qualifications, then you must also be in line with these ethical standards and codes of conduct. And actually, one of the first examinations you may do with either of the professional bodies to get a professional qualification from them will have an element of ethics within the module. And this is where we'll conclude the first part. Hello, and welcome to the part 2 of this lecture on integrity and ethics within the professional practice of the financial services sector. In this second part, we're going to look at some of the ethical dilemmas that we face when we're working within the financial services sector, some of the ways we can combat acting unethically, and how the regulators see ethics. So, one of the big dilemmas is the role of a financial agent. The role of a financial agent is someone that works on behalf of a client, or if it is the likes of the board of a firm, who are they acting on behalf? Are they acting on behalf of the company, or are they acting on behalf of shareholders? So the role of an agent is a kind of critical one when it comes to making the right decision in the interests of the customer or its shareholders or stakeholders. So one of the big ethical dilemmas, certainly for someone that is remunerated based on sales, would be who are you more interested in, your client or your own personal wallet? Well, obviously from a regulatory point of view, treating customers fairly and doing things in the interest of your customer is of course the utmost importance here. But let's be honest, we're all human, and what drives some people. But how do you make people aware of this and their behaviours when they're acting as the role of an agent? Well, it starts with, I guess, training. You really need to be trained to work within the mindset of an ethical person. If you're a member of a professional body, then as I've noted in the first part, you would have passed the likes of ethics tests and be in line with their codes of conduct. So yes, the first part is training, and at least being aware of ethics. We sometimes say it's quite difficult to change people's ethical behaviour, but it's more easy to make people aware of ethical behaviours, and then this could potentially in the long run help them change their ways. When it comes to ethical dilemmas, of course you really should do the right choice of action that benefits your client rather than yourself, and wherever challenged, be open and have an honest discussion about said ethical dilemma. But only from a regulatory point of view, you're doing it to maximise your client's interest, not your own. But when it comes to the likes of the board of directors, then they have potentially lots of different stakeholders to satisfy, whether that be shareholders, stakeholders in the form of customers or staff. Then where do they accept the ethical stance of the business and who do they act on behalf of? So let's just look at some of the regulatory points that the role of the agent must adhere to. And again, look at the highlighted language, obey instructions. In other words, if you're asked to do something by your customer, that's obviously lawful, then really you must do your role in their interests. And if they ask you of something or give advice on certain things that's within your realm, then of course you should follow what they suggest and answer the question appropriately. But the rest of it, exercise skill and care, utmost good faith, make sure you disclose any conflicts of interest. Then we've seen all this language previously. So the key thing, if you are an agent, like I said, this could be a financial advisor, is that you have a contractual relationship where one party's hired you to engage on their behalf, whether it be for selling financial services or to provide a service. And you must act on the customer's behalf and not your own. One of the big dilemmas when it comes to financial advisory is how do you set up your costing base when you charge clients? Do you have a commission or do you have a fee? Now, obviously this is a bit of an ethical dilemma, but to start with, to make it reduce the ethical dilemma, you can advertise fees and charges up front, thus any prospective client can then fully understand how you operate if they're going to act as your agent. But also market forces come into play here, so of course you can have a look at other financial advisors and what kind of market charges and how they set up their fee structure. But when it comes to charging a fee or a commission, then they do differ and they have their own ethical dilemmas within them. So if we look at the likes of this example from a fee based, and this could literally be where you charge 1% of assets under management. So we have an example here where you would potentially charge the client 1% of the assets under management. So this £200,000, if you work out 1% on a yearly basis, then you'd be charging £2,000. But what happens if you increase the growth of that portfolio? So you've increased it by 150%. So it goes up to 300,000. Then your commission will very quickly go from £2,000 up to £3,000. So this is quite a uniform fee. It's quite easy to understand by clients. But ultimately, the bigger the portfolio, the bigger the fee you get, right? So this ultimately might push some advisors away from dealing with newer clients. And potentially, if it's a newer client with a lower portfolio size, then they might not take the business. And personally, I've seen this before in the mortgage advisory business, where I was a junior member of staff, and if a customer was coming to get a small mortgage, say it was just a 100,000 mortgage, then they might not be too bothered about doing that mortgage, and then they'd pass it on to us junior staff to do it for them, because the commission on this smaller mortgage is not as high as on a bigger mortgage. And especially on the life insurance side, because the commissions on life insurance were a bit higher. If a customer had a smaller mortgage, then potentially they might take out a smaller life insurance policy. So some advisors would just go, it's not worth my while, I'll just pass it to someone who's learning out the ropes. And this did happen, but is that the other advisor helping the junior member of staff by giving them some work to do and some learning, or is it really working in their own interests that they can't be bothered to do a small mortgage because they won't get remunerated properly? So is that an ethical dilemma, or are they helping out the junior member of staff? I'll let you decide on that one. But what's the difference when it comes to commission-based? So a commission-based, you could say you will, in this example, you get 6% of performance. So again, we've got the same example as before, where you have a 200k portfolio, and then if you were to charge a fee, a flat fee of 1%, then of course that would be the £2,000 as we've seen previously. But if you have this portfolio, and then just like the previous example, it increases by 100,000, then you would charge the 6% on the 100,000. Therefore, the planner would receive a commission of £6,000. So very quickly before, you had, if you increased the portfolio to 300k, the remuneration would have been £3,000, 1% of the total. But in this case, you charge a commission on performance, therefore you're getting £6,000 with 6% of 100,000. Again, if you advertise this from upfront, then of course you're thinking, is it an ethical dilemma? However, if you're based on this kind of commission model, then you never know. As the investor on your client's behalf, you might take excess risk that your client was not expecting in order to gain this excess performance, again helping line your own pockets. So you could potentially fall foul of taking excess risk, which benefits you if it goes well, of course. So ultimately, the ethical dilemma here is, who are you working on behalf when it comes to commission? Are you really trying to get your customers' wealth up, or are you doing it so that you can gain more? And make sure you don't fall foul of excessing the risk tolerance of your client, but also if your client has certain diversification needs or even ethical investing needs, make sure that you don't go against these as well. So I have mentioned a lot about advisory, and I have also pointed out in previous lecture that if you're a financial advisor, you're actually a salesperson as well. Although you're trying to help your client, but ultimately you work for a business, so it's a bit of a trade-off here. Obviously, the bottom line is you need to act in your client's interests, and we've made that clear throughout the module so far. But here's an example of what do you do. So you have a client who is getting a bit elderly, they have their life savings, and they want to put it in a certificate of deposit, which is a short-term money market product, which is very low risk and just pays a small bit of interest. But this interest, because it's low risk, might be rather low. It might get chewed away by inflation. Also, it's just put in one asset, so it's not very diversified at all. It is low risk, but there is still a very small element of default risk. In other words, whoever you put your money in the certificate of deposit with, it could go bankrupt. Of course, if this is in the UK, the first $185,000 is protected under the deposit compensation scheme, but there's always that element that if the firm does go bust, then you could still lose out of, in this case, $15,000. So how do you potentially engage in that conversation with this elderly client about diversification and risk tolerance? Now you could start by the example I've just given there, by saying, okay, you've got your life savings here, you do realise potentially in default 15k of that is at risk. Therefore you could advise or recommend that they open a separate bank account to put half and half or something like that to make sure that the deposit compensation scheme covers the full amount. And that's probably quite an easy conversation to have. And again, it satisfies the risk tolerance. But how far do you go as an advisor to help them diversify, potentially take on a little bit more risk to gain a more reward? Again, that could benefit you as the advisor because you might get a commission or a fee for increasing their wealth. But again, they're quite elderly, so you don't want to take excess risk and because you don't want to have too much capital at risk in case they don't get it back. So from an ethical point of view, how far do you push them to diversify and take on excess risk to make sure the likes of inflation doesn't chew away at their life savings? Another way of looking at it is to see what are the signs of a bad financial advisor. Well, we've got a number of bullet points here. However, I think yourself watching this can have your own opinion on what a bad financial advisor looks like. Now, I would suggest one thing: an advisor should never be judged on their performance. If they followed the client, acting as their agent in the proper way of doing it, fully ethical and following instructions, then if the client's portfolio doesn't perform as well, then that's not a sign of a bad advisor. But what is how they conduct this advice. If you have somebody that always looks to the positives and really elaborates on the potential gain, but doesn't acknowledge the levels of risk, if they say, oh, well, this was my performance last year, and try to show how well they are, but they don't highlight that future gains or future performance does not have any bearing on future performance. So if they don't have them sort of caveats. So if we look at the second one, they might potentially advise certain products that favour them in the form of remuneration, or if it's to help out one of their peers or one of their friends by selling this, and it's not really in the customer's interest. So when they're giving kind of restricted advice rather than whole of market advice, but not telling you that they're restricted. Financial advisors, this third point, should never really engage in the conversation of what interest rates are going to look like. They should never speculate on future performance. Of course, they can highlight historical trends and historical averages, but that's with a caveat that it's got no indication on future performance. But yeah, if they start predicting interest rates, that's not really a good thing. Again, I faced this myself as a mortgage advisor when you're having the conversation about should I have a fixed or floating mortgage. And the customer would go, oh, well, what do you think interest rates are going to do? And then it's a bit of an awkward conversation because you can't really engage in that conversation, except from kind of provide the facts on when the interest rate announcements are, and potentially point them in the direction of the Bank of England forecasts if it's the UK. But you really can't say what future interest rates will be. But again, I've seen a few former colleagues kind of engage in this conversation. So for instance, when interest rates were slashed to 0.5% from 5% post-crisis, I remember observing or listening over the phone to colleagues that were saying, well, interest rates have been slashed to 0.5%, so the only way is up. Therefore, I think you should lock into this fixed rate, because if interest rates go up, then you'll benefit from your rate not changing. But if you remember, interest rates stayed at 0.5% for a very long time. So even people that had fixed mortgages for 5 years, then they'll probably pay in a lot higher rate than what they could have on a variable. So I did see that myself. I mean, there's also other things like obviously lavish behaviour, fancy offices, if they pretend to be a lot smarter than they are, using fancy language for simple concepts. Again, this could be misleading and put people in a false sense of security. You think, oh, they're using big language, thus they must be clever, type thing. So really have to try and keep it simple for your customers to understand. And the last one there, if financial advisors like to always compare themselves against previous benchmarks, so say, oh, well, the S&P 500 did this, I did this. Again, without suggesting that future performance doesn't necessarily predict future performance, or if they keep over exaggerating how much they've outperformed, then this could put the client in a false sense of security when it comes to working with this advisor. So there's obviously more than this list. So if you can think of any other signs of a bad advisor, then of course do potentially use that if it wasn't in an exam scenario. We've talked a lot about the advisory side, but again we'll go back to the example of an agent where they're working, say, in the board of a firm, and they're obviously kind of responsible for working with stakeholders. Now, stakeholders, of course, could be shareholders, customers, and employees, as well as the wider community, wherever this firm may be. So if you work responsibly with all stakeholders in mind, then one would argue that the higher the ethical standards or corporate social responsibility, which is a separate thing altogether, but you get the point. If they are high, then technically all your stakeholders should benefit from your acting in an ethical and integral manner. And going back to the discussion paper I mentioned in part 1 from the Financial Services Authority at the time, they did comment that the higher the ethical standards, this could generate significant benefits for all stakeholders of the financial firm. And just to give you an example of the likes of benefits that stakeholders can benefit from if firms or agents, like the board, work in an ethical manner or set good ethical standards throughout the organisation. The first one there being market confidence. So having high ethical standards can really have ramifications through the sector and certainly into the likes of good ethical competition between organisations. And if, say, the UK sector has high ethical standards, then it could potentially attract good ethical business from other places in the world and be seen as a place to do business rather than other countries that may have lower ethical standards. Of course, if you're a consumer, then if you're dealing with this financial organisation and they demonstrate that they have good ethical standards, then you as a customer should be reassured that they're doing everything in your interest. Thus, you kind of have some sort of comfort and protection that the agent that's working on your behalf is doing it in a way that is in line with your own ethical values. And of course, if financial advisors are doing things in your interests, then of course it might potentially have good benefits to you in that you are going to get the right product that you need and they're going to advise you appropriately, ultimately saving you money by getting the best and right product for you. And thirdly there, having high ethical standards should ultimately lead to less issues regarding financial crime or potentially less opportunity for financial crime to take place if everyone's working to certain ethical standards. And if there is somebody committing financial crime, if everyone's working ethically, then certainly likes of the whistleblowing process should be more efficient and there should be more awareness for individuals to spot financial crime and deal with it through the whistleblowing process. So if everybody's ethical, any sort of financial crime kind of goes against how everyone else is working. Thus, you'd think it'd be spotted quite early on. It can be dealt with quite early on in the appropriate channels and authorities. And then lastly there, part public awareness, certainly the financial service sector post-financial crisis, was, let's just say, rather derogatory. Since the financial crisis, quite a lot of the banking sector really had to up its game when it came to public relations and working in an ethical manner. And certainly a lot of reputation damage, limitation and rebuilding had to take place following the financial crisis. And yes, of course, this is when regulators and professional bodies alike both stepped up their stance when it came to working ethically. From a regulatory point of view, traditionally the ethics was kind of seen as a compliance-based approach, so kind of simple box ticking exercises. So in this paper by Payne, from going back to 1994, they suggest there was the kind of compliance-based approach, which is going to be followed by the integrity-based approach to ethical behaviour. And as I mentioned, compliance is kind of like box ticking or acting in the letter of the law and regulation. Now, I gave the previous example that, okay, you can be working within the law, but really, is it ethical? So I give the example of doping in sport for that. But again, you can think from a finance point of view, there's some things that, okay, you're not breaking the law, however, is it really ethical? So it'd be good if you could think of some examples related to finance where, again, they're not breaking the law, but they are not really ethical when they're doing this. So, I mean, just from a consumer example, I might invest in unethical organisations. So if I potentially suggest that the likes of arms dealing firms, the mining sector, tobacco companies, then me trading and investing in these shares, it's not breaking the law. However, am I really coming from an ethical mindset when I'm thinking I'm making money from said organisations which are doing X, Y, Z to the planet or to each other? But again, I'm not breaking the law, thus I can do it. But I can let you think of other examples. I suppose the benefit of having said a legal kind of compliance-based approach to ethics is that they're pretty clear rules that everyone can follow. If there's a detection of misconduct, then I'm sure there'll certainly be sanctions. So if there are sanctions and it's enforced, then the likelihood of you complying to the letter of the law is more likely if you know sanctions are in place if you don't. The alternative to this is the more integrity-based approach to ethics, and this is really where the finance services sector has moved towards post-crisis, because post-crisis there was lots of rules and regulations in place, but you can imagine there's quite a lot of unethical behaviour happening which led to the financial crisis. And if you think, how many people post-crisis have actually ended up in prison? There hasn't been many, because the majority of them still followed the laws, but they acted unethically and based on their own remuneration in some cases. But they didn't break the law, but yet the whole finance sector pretty much collapsed. So quite a lot of that previous behaviour was quite compliant when it came to the ethics rules, but there was still a lot of unethical things happening that just wasn't breaking the law, but ultimately broke the financial system. So we have moved to this more integrity-based approach, where the likes of the management have to set the corporate responsibility and the corporate culture and kind of feed down ethics from the top downwards, with a big emphasis on management setting and leading by example. But also quite a lot of this comes from the damaged reputation of preventing damage of people's reputation following the financial crisis. So when they had to really show to the public that actually we're cleaning up our act, they had to do this by demonstrating from an integrity base and again from kind of corporate culture base of improving how they operate. So if we compare the two, then the integrity base is kind of like what we've seen when it comes to regulation, principles based.
So when we've looked at the previous codes of conduct in the last part, all of them were kind of, these are the principles that you must follow and to be ethical. And some of the language they used for the principles of good ethics and code of conduct was in line with how the likes of the regulators authorise individuals, like open, honesty, acting with integrity, skill, care and due diligence. So this integrity-based approach is very similar to the principles-based approach of regulation. Whereas the compliance-based approach, as previously mentioned, is really, this is the rule, as long as you stick to that, it's fine. But we show lots of examples where you might follow the rules, but it's still pretty unethical. So yeah, as noted, it's kind of like box ticking exercise. Of course, similar to the previous argument about regulation, principle-based is much easier to implement, but harder to understand. But compliance-based sometimes can take a lot longer to implement, but everyone can understand it. It's following the letter of the law. And lastly, we'll just finish off by rewinding back to the financial crisis. And I'm sure what you'll have seen from some of the previous lectures and some of the activities we've already done, where we've covered the likes of the film The Wolf of Wall Street. We've seen throughout that film plenty of examples of unethical behaviour. We've also seen from The Big Short the kind of sales tactics that some of the banks were using when it comes to selling credit default swaps, and some of the conflict of interests that were in place when they were kind of backing against themselves on this. We've seen the likes of the libel rigging scandal where there was collusion involved. We've seen high pressure sales when it comes to the mortgage industry in the US, where they're potentially pressurizing individuals to take on mortgages they simply couldn't afford, but in the promise that the house prices would go up in value, therefore would make them wealthier, and therefore they could afford the mortgage eventually. We're seeing how some firms put the likes of profitability well ahead of the customer's interests. And we also seen the likes of the larger institutions getting to a point where they thought they were too big to fail, and they exuberated what's known as moral hazard into the financial markets. Therefore, moral hazard means that they know they can act a bit recklessly because central governments would not allow them to fail. So they could act in a reckless manner to take excess remunerations. Then if they were to potentially fail, they knew that the central banks or the governments would back them up and bail them out, which exuberated a lot of moral hazard into the sector. Again, that is a rather unethical practice. Thus, the big changes in the regulatory landscape, the range of regulations put in place, certainly to prop up the capital amounts within banks to make sure they have a more safe foundation in the event of a financial shock, and certainly the authorization of individuals, whether that be the lower junior staff up to the managers and then the board. They all have to go through certain authorization processes to ensure that they act in an ethical manner, again using the same language as uphold integrity, skill, care, due diligence and open and transparency. I look forward to having quite a few debates regarding ethical dilemmas with yourselves. There is some directed study, so please have a look at the FCA's Code of Conduct, the Chartered Institute of Security Investments Code of Ethics, similar to the websites I showed you in part 1. We also have 2 papers here that really come out post financial crisis to kind of look at some of the ethical issues faced by our sector. So you can see from an academic point of view what authors have done regarding this area and published in some very good journals here. Thank you for listening, and I look forward to having some good ethical debates with yourselves in the future.